So yesterday, someone told me about the Zerodha 60-day challenge, and the concept of it seemed pretty interesting to me. So I went to the website, and here is what it says. The challenge is to trade profitably over 60 trading days. Once you start, over the next 60 trading days, if you are net profitable, you are declared as a winner and certified as a profitable trader. Now, from what I understand from this statement, is that even if you have a very minimal profit, say of 10 rupees, you'll still be considered as a winner and issued the certificate. On the certificate, it says that Zerodha 60-day challenge first time winner, and you can also redo the challenge for more than once. So if you win the challenge for 4 times, you'll be considered as a profitable investor for over a year. I really liked this concept and wanted to see the database कि इंडिया में कितने profitable traders है over a span of 1 year, and the data I found was shocking. About 2 lakh active traders monthly, of which 1,000 were winning the first time, 350 people winning the second time, and less than 100 for the fourth time. Which means that more than 99% of traders lose money in their trades. Let's see how not to. So the most common method people use is buying an option. It converts a straddle into an iron fly and a strangle into an iron condor. But it will reduce the magnitude and probability of profit because to buy option you need additional capital. Most of the times buying premium will lead you to a loss because you're buying premium in a very risky position of your trade, where the volatility is probably high and therefore you have to pay more premium. Now, why is that? This is because the chances of all options finishing in the money increases, and I'll explain that in a latter part of this video itself. Volatility is the rate at which a price of a stock increases or decreases over a particular time period. And a higher stock price volatility often means that there's a higher risk of money to put in and helps an investor to estimate the fluctuations that may happen in the near future. Coming back to what I was saying, even though buying an option requires less capital as compared to selling an option, you have to pay it upfront. And that is one major fact that I want you guys to remember. All types that I'm telling you today, like buying an option, there's hedging with time and putting additional capital, we have to decide the end point of hedging. Because when the markets are violent, it is okay to accept a minor loss instead of battling with the market itself. And markets are very efficient at proving us wrong anyway. And an example of this is a covered call. Please refer to my previous video, I'll link it above, or you can also check the description to find the link of the previous video. So a covered call is the high risk strategy in the sense that if the stock price falls significantly, you'll have to hedge it with time and you're left with no other option. Another problem with buying an option is that when the volatility finally decreases, the premium decreases along with the theta decay. So both the volatility and the theta decay work against you. And here's a graph of how theta decay or time decay works. It is never a linear straight line. It increases as the time goes by. The second way, putting additional capital. The problem with this is that capital requirement for the trade grows exponentially, which might lead to a capital crisis. Before it goes intrinsic, it is a good idea to see the premium and divide it in two so that you can sell one call and one put if you're neutral, or if you have a bullish or bearish bias, sell additional calls or puts opposite to your view. But if the gamma threat or the delta generator, as I call it, troubles you in the last 10 to 15 days, you might want to roll over the trade to the next expiry and sell the desired premium of call and put for the next expiry. But this will divide your monthly ROI into 2 or 3 months since you rolled over your trade. The third thing, saving a trade by this method might require you to put about 20 to 30% more margin than you already have. But if you fall short of capital while doing this, you'll be in a huge loss. because, as I said, the capital requirement grows exponentially, and if you don't have that much capital in your bank, the broker will square off your trade and you'll be in a huge loss nonetheless. So you need to be a very active trader to manage such trades. And if you're not a trader and you have a job, this will be super difficult to manage, and invariably those folks land in a loss. So let's say you tried all of this, but you're still in a loss. What do you do now? How about making the stock pay rent for giving you a loss? So if you know that the index or the stock that you're trading in is a good one, it will show up in profit someday or the other. It's similar to how you put money in a mutual fund and forget about it. Here's a classic example of what I just said. INFI on 14th October 2019, which was when there was a whistleblower notice against INFI, so the stock had a gap down. But if you're hedged with time, on 20th February, the price recovered to the original level, which was before the gap down, and you practically lost nothing. So, hedging with time requires a lot of patience, and here is the importance of trade psychology. And just like I said, the markets are very efficient at proving us wrong, so all your trades cannot be in a profit. But rollover किया जा सकता है. Hedging with time can be a boomerang. You may not be able to liquidate your assets when you want them the most, and you don't know how much time it will take for the stock to ultimately rise. So, diversification is the only thing that may work in this scenario. What is important is booking the profit and waiting for the loss to come back into a profit. But उसको time तो लगता है. Here is one of my favorite quotes from Keynes, who opposed the classical theory of economics, saying that in the long run, we are all dead. Your trades today can be in a profit, but your trade tomorrow can be a loss, and a huge one. The last point. You can buy a hedge for the untested leg and manage the position on a tested side. But more on this in the next video. Till then, bye bye.